1. What is partnership? Explain the essential features of partnership. 1. Partnership is a business organization formed by two or more persons to share profits and losses. 2. It is governed by the Indian Partnership Act, 1932. 3. It involves an agreement between partners, either written or oral. 4. There must be a lawful business activity carried on by the partners. 5. The profit and loss are shared among partners in an agreed ratio. 6. Each partner acts as an agent and principal for others. 7. The partnership firm has no separate legal entity from its partners. 8. It is based on mutual trust, confidence, and consent among partners. 2. Explain the difference between revaluation account and realization account. 1. Revaluation account is prepared at admission, retirement, or change in profit ratio. 2. Realization account is prepared at the time of dissolution of a firm. 3. Revaluation is used to record changes in assets and liabilities values. 4. Realization records sale of assets and payment of liabilities. 5. The balance of revaluation is transferred to partners' capital accounts. 6. The balance of realization shows profit or loss on dissolution. 7. Revaluation continues the business, realization ends it. 8. Revaluation affects adjustments, whereas realization affects closure. 3. What do you mean by fixed and fluctuating capital account? 1. Partners' capital can be maintained under fixed or fluctuating methods. 2. In the fixed capital method, the capital balance remains constant. 3. Under fluctuating capital, the balance changes every year. 4. Drawings and interest affect fluctuating, not fixed capital. 5. A separate current account is maintained in the fixed method. 6. Fluctuating capital has one combined account for all changes. 7. Fixed capital ensures stability, useful in large firms. 8. Fluctuating capital gives a true picture of partners' financial position. Nash 4. Explain the insolvency of partners. 1. A partner is insolvent when they cannot pay their debts. 2. Their private assets are used first to pay private liabilities. 3. Any deficiency in capital is borne by solvent partners. 4. The rule Garner v. Murray applies in case of insolvency. 5. Insolvent partners' capital accounts are closed through realization. 6. Solvent partners bear loss in their profit-sharing ratio. 7. Insolvency affects the distribution of firm's assets. 8. It results in dissolution or reconstitution of the firm. 5. Mention the guidelines for issue of bonus shares. 1. Bonus shares are issued from free reserves or share premium. 2. The company must not default on statutory dues. 3. Bonus issue must be authorized by the Articles of Association. 4. A board and shareholders' approval is required. 5. Reserves used must be realized profits, not revaluation reserves. 6. Fully paid up shares are eligible for bonus issue. 7. The company must not issue bonus shares in lieu of dividends. 8. A SEBI guideline mandates disclosure of all bonus-related decisions. 6. Define debenture. Explain different types of debentures. 1. A debenture is a written acknowledgement of debt by a company. 2. It carries a fixed rate of interest, payable periodically. 3. Bearer debentures are transferable by delivery. 4. Registered debentures are issued in the name of holders. 5. Secured debentures are backed by company assets. 6. Unsecured debentures have no security. 7. Redeemable debentures are repaid after a fixed period. 8. Convertible debentures can be converted into shares. 7. Explain the methods of goodwill. 1. Goodwill represents the reputation and earning capacity of a firm. 2. Average profit method takes past profits average as goodwill base. 3. Super profit method considers profits above normal returns. 4. Capitalization method converts profits into capital value. 5. Annuity method discounts future profits to present value. 6. Purchase of profit method multiplies average profit by a certain number of years. 7. Weighted average profit method gives more weight to recent profits. 8. The chosen method depends on business nature and stability. 8. Discuss the methods of valuation of shares. 1. Valuation of shares determines the fair price of a company's shares. 2. Net asset value method values assets minus liabilities. 3. Yield method values shares based on dividend or earnings yield. 4. Fair value method averages net asset and yield values. 5. Market value method uses stock market quotations. 6. Intrinsic value method reflects real worth of shares. 7. Replacement cost method uses the cost of replacing assets. 8. Choice of method depends on purpose and nature of valuation.